Hello, this is Francesco Nagari, Deloitte Global IFRS Insurance Leader. Welcome to our new IFRS 17 webcast. Today's webcast is titled "The IASB Accepts to Discuss New Topics to Amend IFRS 17, the deliberation process to be completed in 3 months." The agenda for the webcast today is structured around 3 items. First, I'll give you the highlights of the meeting, which was held on the 20th of November 2019, about 2 weeks ago. Then we spend the majority of the time talking about the analysis that we have done of the IASB discussion and the decisions that they've reached. These will be inclusive of a preview on key topics tabled for discussion at the IASB meeting that will take place next week between the 10th and the 12th of December. And then I'll spend a few minutes at the end to talk about the next steps from where we stand at the moment. So in terms of the highlights, the meeting in November was the kick-off meeting of the proper deliberation process. The October meeting was more a warming-up meeting, in my opinion, where the description of the nature of the feedback received was tabled in a relatively informal way by IASB staff. This time around, they actually presented formally the report summarizing the feedback received and also analyzing it in terms of geography and type of respondent. And then they produced 3 lists for which they call for a vote. And the vote was approving each of the 3 lists. The first one, including items that are going to be tabled for approval next week, was listing 6 items that, in the opinion of the IASB staff and the board eventually, requires a little discussion, but they are already supported extensively by the respondents. And so the discussion is only to make some small rectifications to the text that was adopted in the exposure draft published last June. These 6 items will be captured in Agenda Paper 2A, which I'll talk about later. The second list is actually the most important one, because this includes the topics for which the IASB tentatively decided to consider feedback received from the respondents for further discussion. Some of the items in this list are planned for discussion next week. 2 of them, in fact, Agenda Papers 2B and Agenda Paper 2C, and we'll cover them in a moment. But what is also important is that this list includes items which are not necessarily from the proposals published in the exposure draft. There are 4 items which I will explain later that are new, and they are effectively the result of the comment letters that Deloitte and others have submitted to the IASB. The third list is also very important, because these are the items that the IASB decided not to consider further because of either the general support received or because the new arguments that they were expecting in order to justify a reopening or a further discussion have not been identified from the comment letters received, and therefore the matters is deemed to be closed as far as the due process is concerned. So when we go through this list later, you will see that some of these fairly long list of items are important ones, and I'll pick a few to give you an idea of what would be effectively the new text that will appear in the amended IFRS 17 or not. And some of the items were actually to reject the proposal for change on the grounds that what is in the IFRS 17 as we know it today, before the exposure draft, is still deemed to be the most appropriate set of guidelines for accounting insurance contracts. So with that summary, let's now dive into the specifics of the meeting. Starting with the comment letter summary, I thought it would be nice to share with you how the IASB staff has been analyzing the comment letters. As of the 7th of November, they received 122 comment letters, so it's quite a large number, not the record number that was received before when the last complete exposure draft was published, but still a very decent number of contributions. From a geographical perspective, that is the table on the left, you can see that 40% of the respondents were based in Europe. They were followed by the Asian group, and then the third most numerous group of respondents includes those respondents which could not be placed necessarily in any particular geography, so they are being categorized as global. All of the other groups from the rest of the world have all been less than 10% of the total number of responses received. From a category of respondent perspective, type of respondent perspective, the largest group is the preparer or preparer representative body, which covers 42% of the letters that were sent to the IASB, followed by a standard setting body, 19%, and then I would say the three types of respondent that I would like to classify as related to professional services organizations or bodies, accountancy bodies, actuarial firms, bodies, and audit accounting firms. So those three together explain 26% of the response letters received. Users, only 4%, and regulators, only 3% of the total. In terms of the tones that were highlighted in the staff paper, three major themes. One is that a number of respondents asked for the scope of some of the amendments to be extended. The second theme is the fact that there are some suggestions to reconsider some of the amendments in terms of developing the ED in a particular way, also to bring back topics that the ED did not cover. And thirdly, there are concerns and implementation questions that some of the respondents have identified more recently, which they have decided to include in their comment letter to bring to the attention of the IASB. In terms of the actual deliberation plan, I would like to start from the second list. The one that I mentioned earlier is, in my personal opinion, the most important list of the three. In here, you can see that the list comprises 12 items, and I've color-coded them in a different way. The first color code is the bold, black, affecting items 9, 10, 11, and 12. They are in black bold color because these are actually not from the exposure draft. These are 4 topics that the IASB staff and the board agreed to discuss further because of the widespread presence in the exposure draft letters that were received. Deloitte actually joined others in recommending further discussion on items 9 and 10 in particular, and I'll talk about the Deloitte position in a moment. Then the green color code is there to highlight the fact that we have, of course, the effective date of IFRS 17 and the extension of the IFRS 9 deferral being recommended and approved for further discussion. You remember from prior webcasts that I've been broadcasting that, in my personal opinion, over the last 12 months or so, the stakeholder landscape around IFRS 17 has reached a level of polarization with a number of stakeholders being in agreement that the effective date has to be changed, but the proposed 12 months delay on the effective date is okay. And then there is another equally large group, but perhaps a little bit smaller, of stakeholders where the majority of the stakeholders in that particular group are preparers of financial statements, which believe that 1 year additional delay on IFRS 17 is insufficient, and they would like to have at least 2 years. So both groups agree that we need to move away from 2021, but one group seems to be okay with the proposal of the IASB to do 2022 as the new effective date, or even more strongly, a small minority inside that group feels that there shouldn't be any further delay than 2022. And then we have another large group that is suggesting 2023 at least as the new effective date for the standard. So I'll talk about that in a moment. And then the last highlight is the blue star. That is marking the 2 topics which have already been produced in an extensive, detailed paper format. They are included in the agenda for next week, and there will be votes from the IASB debating the amendment to the accounting of insurance acquisition cash flows and the recovery of losses from reinsurance contracts held. So let's start our journey into the analysis of these 6 topics in particular, which are very important in my opinion, and I have effectively decided to dedicate the webcast to these 6 to start with. So let me start with the level of aggregation, which is topic 9 in the list of 12 we just looked at. I would like to start by giving a summary of what the staff noted in their paper is the summary of the comments from the various respondents. The first point is that some respondents commented that the board decision to retain the annual cohort should be unchanged. Most of the respondents that commented on the annual cohort requirement were European stakeholders. Other respondents took a different perspective on the annual cohort, and the staff analyzed it across these 5 different subgroups. The first one is that a small group of respondents that were supportive of the board decision not to amend the requirements, and they asked the IASB to reaffirm that decision. Then there was another group who preferred that the IASB amend or delete the annual cohort requirement for all insurance contracts. A third group of respondents were supportive of the requirement generally speaking, or didn't comment on the requirements generally, but suggested that the IASB require an exception to the annual cohort requirements for insurance contracts that we refer colloquially as contracts with mutualization or intergenerational sharing of risks between policyholders. And there is another group of respondents, actually one respondent, urged the IASB not to specify an exception to the annual cohort requirement for a specified subset of insurance contracts. And finally, some respondents suggested the IASB provide further transition relief compared to the existing annual cohorts transition reliefs in the modified retrospective MRA and fair value approach FVA. The thoughts that came from the IASB staff in the November papers are that the IASB should consider, as part of their redeliberations, whether, because of the outreach or the comment letters, additional information that was provided around the balance between the cost and benefit of annual cohorts, whether that is something that should be considered for specific contracts. And that is the part that is relevant for the IASB to consider. So that effectively annual cohorts should be debated for contracts with the characteristics of mutualization, but not for the rest. We'll see later on that the use of the annual cohort for the other type of contracts is in the third list, with the one that is not going to be debated. When we look at the Deloitte comment letter, we actually took a very strong position. We decided that it was in the best interest of the quality of the standard that we raised this point. We had tried to already argued last year during the TRG debate that the standard was not clear. Our perspective is probably around the improvement of the guidance rather than the abolition of cohorts altogether. We feel that actually cohorts are a necessity if you want to allocate the CSM properly in order to reflect the duration and the size of the service, the deferred revenue and the service that you are rendering to policyholders in a given portfolio of contracts and the groups that made up the portfolio. However, the guidance in IFRS 17 on the accounting for the CSM unlocking effectively, when it relates to contracts with mutualization characteristics, could be improved. We think that the standard is actually not entirely clear, and we believe that TRG was right in debating it, but we are not satisfied that was a conclusive debate, and so we have decided to put it in our letter and recommend that there is a much more precise guidance, really fulfilling the principle that is already there. We are not thinking that the standard needs a new principle. We just need to have clear guidance to explain how the CSM of a portfolio of contracts that are displaying the characteristics of mutualization should be accounted for. And this is a simple graph that we have developed to explain it. So imagine a portfolio with 4 groups, 3 are profitable, 1 is loss-making, but they all share the underlying items returns. We believe that the way the principle works, and should be explained clearly in that way, is that each profitable group funds the loss-making group using their share of the surplus, not their share of the loss. So effectively they make good the loss in a way that each group eventually receives the same share of surplus after funding the loss fully. That means that if you do the calculation like that, we think that this is very much in line with the principle that the IASB has written in the standard, but also importantly from a practical perspective, you have the CSM balance, which is equal in each group. And as a result of that, you can avoid the calculation of the unlocking on a group-by-group basis, and instead you just need to do the unlocking at the portfolio level by allocating the CSM adjustments up or down by group. And group remain necessary, in our opinion, to allocate to revenue and profit. But in terms of unlocking, that can be done at a much higher level of aggregation at the portfolio level. The portfolio, which is determined by the perimeter of mutualization. So in fact, it can contain even more than one portfolio. The second topic that was added, besides the proposals of the exposure draft, is around business combinations. In particular, how to account for contracts acquired in their settlement period. Respondents have commented on the fact that the decision of the board to retain unchanged the requirement that an entity classify a liability for settlement of claims as a liability for remaining coverage if the entity acquired the insurance contracts during the settlement period of the claims is not helpful, and that for a number of reasons. First, they think that IFRS 17 should be amended in order to permit, in all circumstances, the classification of these liabilities to be incurred claims liabilities rather than liability for remaining coverage. And second, the financial statements are more useful, and there will be less complexity and cost than otherwise. The thoughts of the IASB staff is that this is there is some very interesting new stuff coming in on this topic, and they would like to consider further feedback in an open, proper discussion that will require a development of a dedicated paper and a full discussion at the IASB in the coming months. Our position is indeed that we believe that further discussion is warranted in this topic. In fact, we think that acquired liabilities for incurred claims currently will be treated as new business in the acquiring entity, and this liability for remaining coverage with the CSM will generate, if you leave the standard as it is, insurance revenue, which is effectively going to be reported for a claims handling activity. And in fact, the acquiring entity has got no standard obligation towards the underlying policyholders. This is entirely the result of a fair valuation of the acquired liability for incurred claims that the few investors we have been talking to are likely to discard from their analysis of revenue and reclassify as an adjustment to the insurance service expense, effectively treating it as a run-off gain or loss from the settlement of the liability acquired. We think that the IFRS could be retained as it is as far as the measurement is concerned, but for sure the presentation should be amended to be more useful and to reflect what we think is a more faithful representation of the underlying economic reality. The third area where the IASB will conduct a further discussion is interim financial reporting. And here the comments from the respondents indicate that there are a number of practical experiences now that would indicate that these requirements would create more significant practical burden than the burden that the requirement in paragraph B137 was supposed to alleviate. Also, that this will produce a fundamental change from the existing insurance accounting practices as far as interim reporting is concerned. And finally, the information that is produced with B137 is deemed by a number of other respondents to be less useful than it would be if that paragraph was deleted. The staff concluded that the comment letters and the outreach have brought new information in the area of assessing the cost and benefits of this paragraph, and so there is a justification in their mind to consider further the feedback from respondents. The Deloitte position on this item was neutral, so we didn't comment in our response letter. We have noted that this was a deviation from IAS 34 since the time this was published. The basis for conclusions explained that in IFRS 17. However, we confirm that it is evident from our implementation work globally that this requirement is more burdensome than if the standard was to be aligned back to the general principle in IAS 34. So we'll see where the board decides to go on this one. The last of the new topics is the one that comes with a degree of sundry nature, in the sense that it contains a degree of transition modifications and reliefs that are new, and the IASB staff decided to consider further in assessing. There are a number of other points that the staff analyzed. For example, the more extensive suggestion that there is a less restrictive approach to the modified retrospective approach, and the application of a greater relaxation on the fulfillment, on the full restatement approach. These two comments or group of comments were not accepted, so you can see that the staff suggests not to do that in the future board meetings. But they did accept that there are some additional specific transition modifications that have come through the response letters, which will be tabled in a sundry paper that the IASB staff will prepare for January or February. Then, if I look at the two items in the list that have now been prepared for discussion next week, so these are two papers which you can download from the IASB website. They will be published on the 30th of November. The first one is on expected recovery of insurance acquisition cash flows. The feedback, as documented in the November paper, indicates that some respondents suggested to provide guidance on how to allocate the acquisition cash flows to expected renewables, and also to determine the impairment loss. They also suggested to clarify the unit of account for the recoverability of the asset, and also to clarify the interaction between the wording of the proposed amendment and other requirements in IFRS 17. Some other respondents expressed the view that the proposed requirements to assess the recoverability are unduly complex and could be simplified. The staff thought that the feedback provides support for the IASB to confirm the proposal of introducing these pre-coverage asset accounting, but there should be a consideration of a range of suggestions from respondents in the deliberations that for this particular topic will take place as of next week. And so if I look at that paper from next week, the recommendations that the IASB staff has put together for the board to discuss and vote are to confirm the pre-coverage asset accounting, including costs such as commissions that are calculated on a particular contract but economically relate to future renewal of this contract. The second recommendation is that the group of contracts is the unit of account when the acquisition cash flows are allocated. However, the impairment of the asset before it is allocated to a group is the portfolio for which the acquisition cash flows were paid. The third recommendation is that IFRS 17 will require a roll forward table in the footnotes for the pre-coverage asset, and these assets will be part of the portfolio carrying amount in the balance sheet. It will not be presented separately. And finally, the disclosure on the expected allocation of the pre-coverage assets in appropriate time band will be confirmed in the final text of IFRS 17 as amended. Our point of view on this topic is that we are supportive of the change in IFRS 17. Our first recommendation is to improve the impairment testing. One part of that is how to calculate the future net inflows, in particular to make sure that you use future expected measures of the time value of money as far as discounting is concerned, and then to discount it back using the discount yield curve that is applicable to the portfolio at the reporting date in order to calculate the recoverable amount. That guidance at the moment is not present in the exposure draft, and it will be better consistently applied if it was there. Our second recommendation is to ensure that there is consistent application in the eventuality that an insurer uses the premium allocation approach. The accounting policy choice on the treatment of acquisition cash flows, in our opinion, should only apply after allocation from the pre-coverage asset. The other topic that will be discussed and voted next week is related to question 4 in this procedure after insurance contracts held and the recovery of losses. The feedback from the November meeting is that most respondents were supportive for the objective of the proposed amendments. However, they expressed the view that the proposed amendment requires refinement to achieve the board's objective of making it easier for entities to explain their results to investors. And in particular, they had concerns on two areas. One is the proposed population of reinsurance contracts held for which the credit could be recognized on day one seems to be too narrow. And second, the calculation for the loss recovery seems to be unclear in some areas, and there were concerns that the proposal would result in an entity recognizing income on a reinsurance contract held that is in a net cost position. The staff thinking is that the feedback provides new arguments that the IASB can consider as they finalize this amendment, and also that there are valid new pieces of information that could be considered in the feedback. And so in that regard, the paper that has been published at the end of last week extends the scope of the proposed amendment to require an entity to adjust the CSM of a group of reinsurance contracts held when the entity recognizes a loss on initial recognition of an onerous contract or an addition to onerous contracts to that group. Confirm that the above amendment would apply only when the reinsurance contracts held is recognized before or at the same time of the loss that is coming from the underlying insurance contracts. Amend the proposed calculation in a way that there is an alignment to the extension of the scope of this new amendment. Delete the requirement of a footnote that was called out from paragraph BC 304 in the basis for conclusions, and then clarify finally that this amendment to the paragraph 66C Roman 2 applies in a particular way also to the insurance contracts that are measured under the premium allocation approach. We are supportive of this direction that the staff is taking because we recommended also in our letter to extend the scope of the exposure draft, and this seems to be going in the same direction, perhaps not as extensive as Deloitte wanted it, but definitely this is a movement that will be favored by our professionals. I'd like then to move on to the last of the topics on the list that will call for extensive discussion, and just tell you a little bit about what the IASB staff said on the effective date. They explained that almost everyone was in favor of changing from 2021, the current effective date in the published IFRS 17, but there is debate as to whether this is going to be 1 year or 2 years. In addition, respondents were also very supportive of maintaining an alignment between the new effective date for IFRS 17 and the extent of the delayed adoption, mandatory adoption of IFRS 9 for insurance with significant insurance, with entities with insurance operations. The staff thought that the comment letters provided support for the IASB to confirm the change of the current effective date in IFRS 17 and to do the same for the current deferral of IFRS 9. But there should be a discussion because, as I mentioned earlier in the highlights, the staff confirms that there is a degree of polarization with a little bit more than half on one camp, effectively either being okay with 2022 or even demanding 2022 and nothing else, and another camp that says actually 2022 is not good enough and there should be at least one extra year to 2023. So this important topic will be tabled for discussion either in January or February. When I read the cover notes for the December IASB meeting, I think I am starting to develop a personal expectation that perhaps the staff is looking at the February meeting more than the January meeting, but we'll see whether this soft prediction turns out to be right in the new year. Moving then to the first list that was approved unanimously in November, which will be now tabled for discussion next week under agenda paper AP2A. Here you got the 6 items that the IASB staff and the board approve to have just a little discussion, but in anticipation of approving pretty much what was in the exposure draft. The first one is the scope exclusion for loans. They will confirm that these will be voluntary with an irrevocable designation on a portfolio-by-portfolio basis. And IFRS 17 will not contain any guidance as to what will be the accounting of these insurance contracts slash loans under IFRS 9 if you choose to do so, vis-a-vis particularly the passing or not of the SPPI test. The second topic is to approve the amendments on how to set coverage units for insurance contracts with VFA in a way that they will be inclusive of both insurance and investment services. The third one is to confirm that the level of aggregation for balance sheet presentation is higher than recognition and measurement. It's not a group of contracts, instead is the portfolio, and reinsurance contracts will be reported separately. So we can have no more than 4 balances on the balance sheet, 2 assets and 2 liabilities, if all of the possible combinations are taken up by the actual numbers. The fourth topic that the staff proposes to approve is the applicability of the risk mitigation option to our insurance contracts held. So those contracts are effectively becoming now permissible hedging instruments in the new form of hedge accounting that the IASB has defined as the risk mitigation option. The fifth topic is about transition relief for business combination. There is a slight expansion of the proposal to make it applicable not only to business combination but also portfolio transfer. And then finally, the adjustment to the transition reliefs for the risk mitigation option. There is confirmation that you can restate fully comparative P&L, and also you can elect to apply the fair value approach on the hedged item, effectively on the insurance contracts which are part of the risk mitigation relationship at transition date rather than at the point in time where you have impracticability of full restatement. If I then move on to the third list, so this is the list that I explained earlier, will be effectively signed off already as of the November board meeting. It's not going to come back next week or in the next 2 months. These are items which effectively, as proposed in the exposure draft or in the previous decisions which may have rejected some of these topics, will not be debated again. And I've picked a few of these, so let me just take you through the ones that I thought were particularly important. The first one I wanted to discuss with you is agenda item 5. So the list 5, that's the one about cash flows in the boundary of our insurance contracts held. There was a decision not to expose any changes in that area, and a number of commentators, including Deloitte, commented on this topic. We at Deloitte did not actually suggest to change the contract boundary definition for contract held, despite we acknowledge that there is accounting mismatch, but we think that there is another way to address the accounting mismatch, which is effectively to modify the way the CSM is unlocked for those cash flows arising from underlying insurance contracts which have yet to be issued but will be insured and within the boundary of the insurance contract held. That effectively maintains the balance to 0 all the time, and there is no distortion of the P&L by reporting an insurance finance income or expense line item that arises entirely from the difference between the current discount rate used for measuring the fulfillment cash flows and the discount rate used to calculate the unlocking adjustment to a CSM that until the session takes place, because the contract has been issued, remains fully unearned. Well, we'll see what happens on this one. Number 6 is the subjectivity in the determination of discount rates and risk adjustment. A number of people asked for a more prescriptive set of rules, and the IASB decided that there are no new arguments that will actually convince them to do anything other than to retain the requirements in the current text of IFRS 17. On the risk adjustment for non-financial risk in the consolidated group of entities, again, a number of respondents commented that there should be guidance on how to deal with the difference in diversification benefits between group and subsidiaries, but the IASB felt that no new arguments were brought to their attention, so they will not reopen that topic for us to see a different set of guidelines in the standard. And the last one I want to mention is paragraph 11. The scope of the VFA will not be reopened, will not be extended to include also insurance contract issued or held by all means. Although for the held, there is the fact that the risk mitigation option allows a quasi-VFA accounting if they are part of that hedging relationship. But for the issuer of an insurance contract, that is not the place. In Deloitte, we did actually recommend this amendment to go through, but we have to accept that the IASB felt that our arguments are not new in nature, and therefore there is going to be no reopening of this topic in the coming IASB meetings. The last of the points in the list of items that will not be discussed is one that, in my personal opinion, has got a very significant impact in the world of insurance, and that's the decision to do nothing about the accounting for insurance contracts issued by mutual entities. I'd like to spend a little bit more time on this topic to explain what the IASB staff summarized in terms of comments from respondents, where they said that a small number of respondents commented on the board's decision to propose the addition of a footnote in this particular paragraph, and the comments were mixed. Half of the respondents they were supportive. The remainder were actually in disagreement with the decision, and considered that the feedback, not only in the footnote and in the paragraph, but also in the other paragraphs that go from BC 264 to BC 269, are actually inadequate to portray the economics of insurance contracts being issued by mutual entities. And the same is true, according to these respondents, of the educational material that has been developed by the IASB staff. The staff actually thought that the IASB does not need to discuss this topic as part of the deliberation and should just confirm the footnote that they decided to add. And so there is going to be no reopening of the application of IFRS 17 to mutual entities, I'm afraid. So then coming to the last of my slides for today's webcast in terms of the next steps. As I noted earlier, the IASB wishes to complete the redeliberation process in 3 months, starting from this month. The papers have been published already for a few days, so please download them. The meeting is 3 days, next week, from the 10th to the 12th. I checked just before I opened the webcast if there was a specific date already advertised, but not yet, so that will come through later. And you can see that the summary here on the slide is just recapping on what we've been through. First paper on the amendments that require little discussion, the 6 items, and then 2 papers specifically on 2 items out of the list of 12 that require more fundamental discussion, more substantial discussion at the board. So that leaves 10 other items, including the discussion on the effective date for the January and February 2020, when these 10 remaining items will be debated. One could argue that maybe they're going to do 5 in each of the 2 meetings that remain, but we'll see after our holiday season whether that is going to be the case in the January agenda of the meeting. That is the last of my messages for today's webcast. And as I take you to the last page of the presentation deck, I'd like to invite the recording to be stopped and to open the floor for any questions.